With interest rates still higher than what buyers got used to over the last couple of years, you might have heard someone say, just do a 2-to-1 buy down. But is it actually a smart move? Or is it something that will save you money now, but then cost you money in the long run? I'm gonna break down exactly how temporary buy downs work, what they are, what different loan types allow them, and if it's a smart move. A temporary interest rate buy down is different from a permanent rate buy down in the sense that permanent rate buy down, say for example, the going rate was 6% and you want to buy your interest rate down to 5% to benefit the lower monthly payment. Your overall interest rate at 5%, that's what your interest rate is going to be forever. With a temporary rate buy down, what it does is it acts as if you had a lower interest rate for a set amount of time. So for example, there are 3-year, 2-year, 1-year interest rate buy downs, or 3-2-1, 2-1, 1-0, and where the seller's credit is going to subsidize your monthly payment. Essentially what it is prepaid interest. The seller is giving you a seller credit, that's cash. The cash is going to sit in an escrow account. The escrow account is going to be held by your servicer. And what the servicer is going to be doing is they take money from this escrow account, and depending on what type of buy down you had, they're going to subsidize your monthly payment. So your monthly payment is going to be as if you had that lower interest rate, but in reality, your interest rate never really changed. It's the same as that base rate that you initially qualified on. However, your monthly payment will be lower, so you will have monthly payment savings. The different loan types that allow this are going to be conventional. Conventional does allow for a 3-to-1, a 2-to-1, and a 1-to-0 buy down. However, with conventional, the seller credit is going to be limited depending on how much money you put down. If you put down less than 10%, the maximum seller credit is going to be 3% of the purchase price. If you put 10 to 25% down, the maximum seller credit is going to be 6% of the purchase price. And if you put more than 25% down, the max seller credit is going to be 9% of the purchase price. It's only allowed for primary residence and second homes. It is not allowed for investment properties with conventional. FHA will be just about the same. They do allow a 3-to-1, a 2-to-1, and a 1-to-0 buy down. And the only caveat with the FHA and all of them is really that you still have to qualify on your base or your starting rate. That's going to be your qualifying rate. If you are going to be subsidizing your payment with a temporary rate buy down, then that effective payment is not what you qualify off of. It's going to be the worst case scenario. VA allows for the 2-to-1 buy down. VA, same thing, same rules apply. Now, jumbo or DSCR or investment type of loans, or what they call non-QM, which are not your typical qualified mortgages that we always talk about, like conventional, FHA, VA, and USDA. If your loan fits outside of that box, it's not very likely that you will be able to use a temporary rate buy down, but every lender and every investor out there is going to be a little bit different. Some do allow it, just depending on your situation, just depending on how much money you're putting down, your FICO score, your strength as far as your buyer profile. Typically for these types of scenarios, the buyer is going to use a permanent rate buy down, or sometimes they'll get into an adjustable product that they can take advantage of that lower monthly payment at the beginning of the life of the loan. Who pays for temporary rate buy downs? Well, it can't come from the buyer. It has to come from a third party. So traditionally, it comes from the seller. So the seller provides you a credit, and then you can utilize that credit for these temporary rate buy downs. You can negotiate these types of credits into your offer, into your deal, so that the seller isn't taking too much of a hit to make this happen for you. And the benefit that you're going to get from it is going to be a lot higher than if you just reduce the price on the house. Sometimes builders and lenders can have an incentive with buy down. So it's a smart idea to always ask your lender. And if you're buying a new build, definitely ask the builder. The question is, does it actually save you money? The short answer is yes. But for this example, let's say you bought a house for $500,000. You put 5% down. Your effective monthly payment would be $3,080 a month. if you had a 6% interest rate. With a 2-to-1 buy down, in that first year, your interest rate is going to be 2 points lower. So you effectively have a monthly payment that reflects 4% rather than 6%. So your monthly payment would be somewhere around $2,500. In the second year, it goes back up 1%. So instead of having a 4%, now you're effectively have a 5%. So your monthly payment savings are going to decrease a little bit, but you're still going to be getting some compared to your start rate. Your effective monthly payment here would be about $2,650 or so. If we all add up all the numbers, if we add up all the monthly savings, it's somewhere around $5,700 in 2 years. So the savings are definitely there. So when does a temporary buy down make sense? It makes sense if you need lower monthly payments to ease into home ownership. Maybe however much you were paying for rent was very little or nothing, and there's some significant payment shock in buying the house. So this could be the strategy for you. It eases the blow a little bit. You're confident that rates will drop within the next year or two. You're getting additional seller credits that are going unused otherwise. So if your closing costs are fully covered and you still have some seller credit left over, you can take a look at using a temporary rate buy down. Also, if you have stable income and you're expecting it to rise, or you know that you're going to get a raise coming up soon or a bonus or whatever it may be, then a temporary rate buy down might be a good idea for you. When is a temporary buy down not a good idea? When you're stretching just to qualify, you do not plan to refinance, your savings aren't there. The temporary rate buy down doesn't get you significant savings compared to either lowering the purchase price or taking a permanent rate buy down. Or you're unsure that you're going to stay in the house for 3 years. Maybe you're planning on selling your house in 2 years or less. But if you do take on a temporary rate buy down and you end up selling before the time period is up for that temporary buy down, what you can do is you can take the excess that's in the escrow account and you can apply it to your principal. Effectively, if you sold the house, then that puts more money in your pocket. A smart way to structure an offer for a temporary rate buy down is to structure it as if you're needing or asking for a seller credit. Know how much you need for either a 3-2-1, 2-1, or 1-0 buy down, just depending on what your goal is. Talk to your lender about it. Have your lender run different scenarios for you so that when you do make the offer, you know exactly how much you need in a credit and then how much your additional closing costs are going to be. Temporary buy downs can be a powerful tool. It's something that I have used many times in the past to help first-time homeowners ease into home ownership. But they're only powerful if you structure them properly and you understand your numbers and you're comfortable with them. If you're in the market right now, have your lender run the scenarios. Ask them to show you a scenario with no buy down. Ask them to show you a scenario with temporary buy down, and ask them to show you a scenario with a permanent rate buy down. If this video helped clear up any confusion, do me a favor and hit the like and subscribe buttons below. And if you'd like a free consultation, use the link in the description to set up a Zoom call with me.